Did you know that the global bond market is actually larger than the stock market, yet many investors overlook it? Bonds are not just a cornerstone of the global financial system. They offer a universe of opportunities for stability, income, and diversification in any investment portfolio. Imagine being part of an exclusive club where lending money to governments or corporations entitles you to regular interest payments, almost like receiving a paycheck for your investment. This is the essence of bond investing. But here's a shocking fact. Despite their significant role in the economy, bonds can be one of the most underappreciated assets by individual investors. Why? Perhaps it's the perception that bonds are just for the big players, or that they're too complex for the average person. We're here to demystify these misconceptions. In this series, we'll peel back the layers of bond investing, showing you not only how accessible and varied bonds are, but also how they can play a crucial role in achieving your financial goals. From the adrenaline of high-yield corporate bonds to the steadiness of government securities, there's a bond out there for every type of investor. And with the right knowledge, you can navigate the bond market with confidence, unlocking opportunities for income and growth that you never thought possible. So, whether you're looking to build a fortress of stability in your portfolio, generate steady income, or simply diversify your investments, buckle up. We're about to take a deep dive into the world of bonds, uncovering strategies, insights, and tips that will arm you with the knowledge you need to invest wisely and securely. Welcome to the ultimate beginner's guide to bonds. Let's demystify the complex, uncover the opportunities, and discover how bonds can work for you. Chapter 1. Introduction to Bonds. Understanding the Basics. Welcome to the world of bonds. Imagine lending money to a friend, and in return, they promise to pay you back with a little extra as a thank you. Bonds work in a similar way, but instead of a friend, you're lending to a company or government. Why? Because they need funds to grow, build infrastructure, or manage finances. And the extra you get back? That's interest, your reward for lending your money. Now, think of bonds as a safer path in the investing world, often less roller coaster-like than stocks. When you buy a bond, you're essentially buying a piece of debt issued by entities like governments or corporations. They agree to pay you back the face value of the bond on a specific date, known as the maturity date, plus interest payments along the way. These payments are like clockwork, arriving at regular intervals, making bonds a go-to for those who prefer a predictable income stream. But here's where it gets interesting. The interest rate, also called the coupon rate. It's like the bond's heartbeat, dictating how much you'll earn. Fixed rates mean steady income. However, some bonds have variable rates, adjusting over time. This variability ties into the economy's performance, influencing your earnings. Why do people flock to bonds? Safety and stability. In uncertain times, or when the stock market feels like a wild ride, bonds offer a comforting predictability. Plus, if a company goes under, bondholders are in line before shareholders to get their money back. It's like having a VIP pass in the world of investing. Chapter 2. Types of bonds: government, corporate, and municipal. Diving deeper into the bond world, let's explore the main types: government, corporate, and municipal bonds. Each has its own flavor, risks, and benefits, catering to different investor appetites. First up, government bonds, often seen as the safest bet. Issued by national governments, they fund projects and day-to-day operations. In the US, these are known as treasuries. Their risk? Lower than most, thanks to government backing. Returns aren't sky-high, but the safety net is unmatched. Think of it as a cozy, risk-averse investment corner. Corporate bonds, on the other hand, are the wilder siblings. Companies issue them to fuel growth, finance acquisitions, or manage debts. The catch? They're riskier. A company's ability to repay can fluctuate with its fortunes. However, with greater risk comes the potential for higher returns. It's a bit like betting on a rising star in the business world. Lastly, municipal bonds, or munis, are offered by states, cities, or counties. They finance public projects like schools, highways, and hospitals. Their secret sauce? Tax advantages. Often, interest earned on munis is exempt from federal income taxes, and sometimes state and local taxes, too. It's a sweet deal for those in higher tax brackets looking for a tax-efficient investment. Each bond type fits a unique investor profile, balancing risk, returns, and tax considerations. Whether you crave the safety of government bonds, the higher potential returns of corporate bonds, or the tax benefits of munis, there's a bond out there for you. It's all about finding your comfort zone and investment goals in the bond buffet. Chapter 3. How bonds work. Interest rates and terms explained. Bond investing might seem complex at first, but it's like baking a cake. Once you know the recipe, it's straightforward. The key ingredients? Interest rates and terms. Understanding these helps you pick the right bonds for your investment pantry. Interest rates, or coupon rates, are the bond world's flavor enhancers. They determine how much you earn annually from your investment. Picture it this way. If a bond has a 5% interest rate and you invest $1,000, you'll receive $50 each year until the bond matures. It's like getting a thank you note in the form of cash for lending your money. Now, let's talk about maturity dates, the best before dates of bonds. This is when the issuer promises to pay you back your initial investment. Bonds can be short-term, up to 5 years, medium-term, 5-12 years, or long-term, over 12 years. Choosing between them is like picking between a quick snack or a slow-cooked meal. Short-term bonds return your money faster but usually offer lower interest rates. Long-term bonds, meanwhile, lock in your money for more extended periods but often come with the perk of higher interest rates. A crucial concept to grasp is the relationship between bond prices and interest rates. They move like a seesaw. When interest rates rise, bond prices fall, and vice versa. This is important because it affects the market value of bonds if you decide to sell before maturity. Investing in bonds involves looking at this financial landscape, understanding the interplay between interest rates, terms, and your investment goals. Whether you're aiming for steady income, safety, or a mix of both, knowing these fundamentals helps you bake the perfect investment cake. Chapter 4. The relationship between bonds and interest rates. The dance between bonds and interest rates is a fascinating spectacle, crucial for any investor to understand. It's the backbone of bond investing, influencing every decision you make. Here's the deal. Bonds have an inverse relationship with interest rates. When interest rates go up, bond prices usually go down. Why? Imagine you own a bond paying 4% interest, and new bonds are issued at 6%. Your bond's value decreases because investors can get a better deal elsewhere. It's like owning last season's model when a new, improved version hits the market. This relationship affects not just bond prices but also the overall strategy for bond investors. During times of rising interest rates, existing bonds become less attractive, leading to potential declines in their market value. Conversely, when interest rates fall, the value of existing bonds, with their relatively higher interest payments, typically goes up. For investors, this dynamic offers both challenges and opportunities. In a rising interest rate environment, holding to maturity can shield you from market volatility, ensuring you receive your original investment back plus interest. However, the opportunity to buy new bonds at higher rates can be tempting. Understanding this dance is like learning to navigate the ebb and flow of the sea. It requires vigilance, patience, and a keen eye for timing. By keeping a close watch on interest rate trends and economic indicators, investors can make informed decisions, whether to hold steady, reinvest, or adjust their bond portfolios in response to changing economic tides. This intricate relationship underscores the importance of strategy in bond investing. It's not just about picking bonds but understanding how external factors like interest rates affect your investment and adjusting your sales accordingly. Like a seasoned captain, a savvy bond investor knows how to navigate these waters, making the most of the currents to reach their financial goals. Chapter 5. Assessing bond risks, credit risk, interest rate risk, and more. In the bond market, risk is like the weather, always present, sometimes predictable, but often full of surprises. Understanding the main types of risk can help you dress appropriately for the financial climate you're entering. Let's unpack the risks you'll face in bond investing. Credit risk. Imagine lending money to a friend who might not pay you back. That's credit risk. In the bond world, it's the risk that the issuer will default and fail to repay the principal or interest. Government bonds, especially from stable countries, have low credit risk, while corporate bonds vary. A company's credit rating, much like a financial health checkup, gives you an idea of this risk. Interest rate risk. This is about the timing of your investment moves. When interest rates rise, bond prices fall. If you need to sell a bond before it matures during a time of rising rates, you might have to sell at a loss. It's like selling a concert ticket at a discount because the band suddenly isn't as popular. Inflation risk. Your bond payments might not keep up with the rising cost of living, diminishing your purchasing power over time. If you're earning 3% on a bond and inflation jumps to 5%, you're effectively losing money. It's like running on a treadmill trying to catch a dangling carrot that's moving just a bit faster. Liquidity risk. Some bonds can be harder to sell quickly without taking a loss. Imagine trying to sell a rare collectible. The right buyer might not be immediately available. Corporate and high-yield bonds often face higher liquidity risk compared to government bonds. Navigating these risks requires a mix of research, diversification, and sometimes, accepting lower returns for higher safety. It's about finding your comfort level with the various weather conditions of the bond market. Chapter 6. How to buy bonds. Steps for beginners. Entering the bond market is like starting a new adventure. Here are the steps to ensure you're well equipped for the journey. Step 1. Define your goals. What are you investing for? Safety, income, or a bit of both? Your goals will shape your bond choices, guiding you towards government, corporate, or municipal bonds. Step 2. Research. Dive into the bond's details. Look at credit ratings for an idea of risk, and interest rates to gauge potential returns. It's like checking the map before you embark. Step 3. Decide on a purchase venue. You can buy bonds through brokerages, direct from governments, like Treasury bonds through the Treasury Direct website, or bond funds that pool various bonds. Each has its pros and cons, much like choosing between traveling solo or with a tour group. Step 4. Evaluate and select bonds. Consider different types, maturities, and issuers to match your risk tolerance and investment horizon. It's akin to packing the right gear for your adventure. Step 5. Monitor your investment. Keep an eye on interest rates in the economic environment, as they can affect your bond's performance. Regular reviews will help you stay on course or make adjustments as needed. Step 6. Diversify. Don't put all your eggs in one basket. Diversifying across different types of bonds can help manage risk. It's like having a varied itinerary. If one part of the trip doesn't go as planned, you have other experiences to look forward to. Buying bonds can be a gateway to achieving your financial goals, offering a blend of stability and returns. Like any journey, it requires preparation, research, and sometimes, a bit of courage to take the first step. Chapter 7. Diversifying with bonds. Creating a balanced portfolio. Imagine your investment portfolio as a team, where each player has a unique role, contributing to the overall success of your financial goals. Diversification is like assembling this all-star team, ensuring you're not relying too heavily on any single player. When it comes to bonds, they can be the steady, reliable players on your team, providing balance and reducing risk. Why diversify? Just like in sports, conditions can change. An all-stock portfolio might hit home runs during a bull market but strike out in a downturn. Bonds can serve as a counterbalance, often moving differently than stocks. When stocks dip, bonds might hold steady or even rise, smoothing out the ride. Mixing bond types. Incorporate a mix of government, corporate, and municipal bonds. Each type reacts differently to economic changes. For instance, during economic uncertainty, government bonds typically perform well, while corporate bonds may face challenges. Varying maturities. Including bonds with different maturity dates can protect you against interest rate changes. If rates rise, shorter-term bonds can be reinvested at higher rates sooner, while longer-term bonds lock in current rates. Geographical diversification. Don't overlook bonds from different countries or regions. International bonds can offer higher yields and diversify risk, though they come with their own set of challenges, like currency fluctuations. Creating a diversified bond portfolio is a strategic process, requiring regular review and adjustment to align with your evolving financial goals. It's about finding the right balance that suits your risk tolerance and investment horizon. Chapter 8. Tax implications of bond investing. Understanding the tax implications of bond investing is crucial, as it directly affects your returns. It's like knowing the rules of the road before you drive. It ensures a smoother journey and helps you avoid unwanted surprises. Interest income taxes. Generally, the interest you earn from bonds is taxable at the federal level, and possibly at the state and local levels, depending on where you live and the type of bond. This is important because it can significantly impact the net return on your investment. Municipal bonds. Here's a tax-friendly option. Interest from most municipal bonds is exempt from federal income tax, and if the bonds are issued in your state of residence, you might also avoid state and local taxes. This makes munis especially attractive to investors in higher tax brackets. Zero-coupon bonds. These bonds are sold at a discount and don't pay periodic interest. Instead, you receive the bond's full face value at maturity. The catch? You're taxed on the interest that accrues each year, even though you don't receive it until maturity. It requires planning to manage the tax implications. Tax-efficient investing strategies. Consider holding bonds in tax-advantaged accounts like IRAs or 401ks, where interest income isn't taxed annually. This can be a smart way to defer taxes or enjoy tax-free growth, depending on the type of account. Understanding the tax aspects of bond investing can help you make more informed decisions, potentially boosting your after-tax returns. It's an integral part of crafting a strategy that aligns with your overall financial picture.